Very pleased to introduce Liz McGinley. She's a partner at Bracewell and really practices in this area of venture capital. And Liz, let's go ahead and get your panel up and turn your cameras on, and we'll get started with, I think, what will be a really fascinating discussion.
Thank you, Brett, and thank you very much to the Center for Houston's Future. I think we have a great panel today focusing on the role of capital formation in the low carbon future. We all know that this work doesn't get done unless there is capital to help support it. So we have a great panel today to speak to those issues. We have Christina Karapataki from Breakthrough Energy, Troy Thacker from Ara Partners, Zach Gross from JP Morgan, and finally Michael Skelly from Lazard. So I will start with introducing myself. As Brett said, my name is Liz McGinley. I am a tax partner at Bracewell, and I am in the New York office. And although I do not sit in the Houston office, the vast majority of my practice is focused in the energy space, conventional energy, as well as renewable energy, carbon capture, and the hydrogen space, and very focused on project development. So I obviously know the great importance of attracting capital and structuring capital to make these deals work. So I would really like to start with asking the panelists to introduce themselves and to talk about themselves, their organization, and where their organization fits in terms of providing capital for low carbon and clean tech ventures, and where they fit in providing capital in the development process. And Christina, can we start with you, since I know you get involved early in these projects?
Yes, absolutely. So first of all, thank you for having me, and thank you to the Center for Houston Future for organizing this great event. I'm particularly excited to be here because I've lived and worked for about 6 years of my career in Houston. I had to move away for personal reasons, but it's always good to be part of the community and excited to see it moving forward. So personally, I've worked on both sides of the corporate venture capital world and the financial venture capital work. I used to work for Schlumberger in the oilfield services sector in the corporate venture group. And for the last 3 years, pretty much since inception, I've been in the investments team for Breakthrough Energy Ventures. So Breakthrough is a $1 billion fund focusing on investing in very early stage technologies that can significantly reduce greenhouse gas emissions. So we're comfortable taking a lot of technical risk. We go fairly early in the development, so we could invest in technologies and companies that are coming straight out of the university, all the way to late stage venture capital rounds, so Series C, Series D rounds. And the way we're set up is we're trying to put a very operating approach on how we manage our investments. About half of our group are people with operating experience who have worked in startups, raised financing, did business development, sales and marketing, and they provide that experience into the company that we back. And we're also a science-focused organization. Technology comes first, and how we evaluate our investments comes through the technical and science lens. And we're also very fortunate to be backed by 20+ high net worth business leaders. Our chairman of the board is Bill Gates, and we also have a Houston connection through John Arnold, who's also on the board of Breakthrough Energy Ventures. So thank you for having me.
Great, thanks, Christina. Troy?
Hello, everyone. Thanks, Liz. I'm Troy Thacker. I'm one of the co-managing partners of Ara Partners. So we're a Houston-based private equity firm that's focused on making investments in companies that are decarbonizing the industrial sector. So the firm focuses on investment opportunities in industrial and manufacturing, chemicals and materials, energy efficiency and green fuels, and food and ag sectors. So we formed the firm a few years ago around a belief that the global economy is at an inflection point. And in order to combat the effects of climate change, really entire industries need to transform themselves to deliver carbon reducing or carbon negative business models and carbon negative or carbon neutral products and services. So while the investment community has largely focused historically on power generation, whether it's wind or solar, or on decarbonizing transportation through batteries or electric vehicles. Really, the industrial sector, in our view, is the largest single emitter of greenhouse gases globally, particularly when you take into account the power that they consume. So it's a harder to decarbonize sector, and that's where that's why we're participating and trying to make an impact in this part of the economy. Our firm does both small scale buyouts and growth investments in companies that are replacing incumbent processes with low carbon alternatives. So we're happy to make a small scale buyout of a business and help them grow significantly, or we're happy to buy or invest in a process technology and build the first plant. We have a very strong network of industry relationships, technical expertise, and operating knowledge, and we have people, including myself, who've run businesses in the past. And so that's what we bring to our portfolio and what we're looking to continue to invest in here in Houston.
Great, thanks, Troy. Zach, you want to give us some background?
Absolutely, and thank you, Liz, and happy to be here. My name is Zach. I lead the renewables and clean tech effort at JP Morgan. So that's advising large renewable companies, large infra funds that spend time in the space, and increasingly more time on clean tech, whether that be hydrogen, EV charging, residential solar technologies. And internally within JP Morgan, I spend a lot of time on our own sustainability initiatives and working with oil and gas clients, both in the US and Europe, as well as automobile clients around their own sustainability initiatives. In terms of capital formation, I tend to step in after you've survived Christina and Troy. So you've done a lot of the hard work and kind of built a product and started to sell the product. And I'm really about trying to help you find the right permanent capital structure that'll help you reduce your cost of capital and create what is a virtuous cycle that the lower cost of capital you have, the more you can grow it and can create operating leverage. And there's no real kind of one size fits all. Sometimes that's a debt solution, whether it be project debt, Department of Energy debt. Sometimes it's selling to a strategic where we see kind of strong synergies or operating growth that you can do when partnering with an oil and gas or a utility or an automobile client. And then for some companies that are ready to go public and kind of have a significant capital needs, whether that be through an IPO or the topic du jour, and whether it be a SPAC, we work with companies, and there really is a tremendous amount of interest in the public markets for anything ESG related. And what I'd say is when I started covering this space, there were probably, if it was a year where you had 2 companies that survived Christina and Troy's world, it was a success. It now feels like every day there is another ESG focused company that's on my radar and that's doing amazing things, both in Houston and across the US.
Thanks, Zach. That's a great story. Michael?
Hi, thanks for having me on the panel, Michael Skelly. Thanks for having me on the panel, Michael Skelly. And I've been a renewable energy entrepreneur here in Houston for 20 some years. One of around the theme of capital formation, have participated sort of at all levels. One of the companies that we started here was Zilka Renewable Energy, which was family backed by a family with roots in oil and gas, and then sold that to a strategic Goldman, and then to a PE, and then to strategic EDP, which is now one of I think probably the largest renewable energy company based here in town. And then have started other ventures here where had to chase around for money all over the U.S. and also here in Houston. I do a bit of angel investing myself, probably half of it here and half of it elsewhere. And I also am very involved in lots of different civic activities, from the Parks Board to Bike Share to Link Houston. So I spend an inordinate amount of time actually thinking about like, what does the ecosystem look like? I'm also on the board of Greentown Labs and have helped get Renewable Energy Alliance Houston off the ground. And then my day job is I'm a senior advisor at Lazard and working pretty much just on renewables. And Houston is actually a really good place for that because it's in the middle of the country, and everybody who perhaps wasn't thinking about this energy transition 5 or 10 years ago, they're all thinking about it now. So knowing a little bit about the sector, it's, we find it useful for Lazard's clients to have some resident expertise here in town. So thanks for having me on the panel, and look forward to the discussion.
Well, Michael, I think that was a perfect segue into our next topic, since you've talked about your participation in the space for so long in Houston. Let's focus specifically on Houston. And, are we seeing a lot of deal flow in this space in Houston? And what kind of deals are we seeing?
Is that to me? Should I start off? Yes?
Sure.
Yeah. Well, I think we're seeing a lot. I mean, there was sort of a first wave of companies in the early 2000s. That was Superior, started by a guy named John Calloway, and then Zilka, we were involved, and then people have left those companies, started other things, and then the Europeans got involved. European oil and gas companies have gotten involved. So there's a lot of activity from small companies to bigger companies, and then out of those, people spin out and identify opportunities, and off they go. But it used to be the case that you wouldn't even think about looking for money in Houston. But now there's, most of the PE funds are either have started a renewable energy fund, or they're thinking about starting one, or trying to figure out how to invest. There's lots of strategic capital looking around, trying to figure out how they can invest in this space. So dramatically more activity than there was, 20 years ago when I started in wind. Everybody was working at Enron or at some .com, and it felt like wasn't lonely, because people in Houston are very friendly, but it was odd. It was downright odd to be in renewables in Houston back then, and now it's embraced by just about everybody.
Thanks. That's a great transition. So tell me, Troy, why is it that your organization is investing in this space, and how important are the financial returns to the investments?
Well, first I'm going to answer the why in Houston, and then I'd be happy to answer that. But look, we're in Houston for a very specific reason, and that's that we've got the people in Houston to make the industrial transition happen. When you think about the greenhouse gas emissions in the industrial economy, you need very strong engineering talent. You need a strong blue collar labor force. You need people with a sort of get it done attitude that is here in Houston. When you're scaling an industrial enterprise, you need to have not just the people, but you also have to have supportive local governments that want you to build a plant here. And when I think about the capital that we provide, it's to build those scalable business models that are capital intensive. When I think about venture capital on the West Coast, it's largely data centric, or social media centric, software oriented. Or on the East Coast, it's very financially oriented. It's the financial center of the world in New York, but here we're really the industrial capital of the world. And so this is a great place for us to be executing our business model. We have one of the largest concentrations of mechanical and chemical and civil engineers at really anywhere in the world, and an incredibly able group of people. And as for returns, look, we're an investor. Our job is to make money. We've been hired by large institutions, pension funds, university endowments, to make money, not to do their philanthropic work. So we firmly believe that the wind is at our backs right now in creating the businesses of the future that can truly remake entire parts of the economy. When you can create a material or a product or or provide a service in a sustainable way, but do it cost competitively, you have the avenue to really take market share in today's environment. That might not have been the case 10 years ago or 20 years ago. But today, with consumers and corporates starting to really focus on the carbon footprints of the things that they buy and consume or use, we think today it's a great opportunity to provide more sustainable materials, chemicals, and industrial products.
Troy, those are all great points, and we've certainly heard over and over again how a lot of the infrastructure in terms of both capital as well as human capital that's already existing in Houston from the conventional energy phase is really very well suited to adapting into, a clean tech environment. Zach, we've heard a lot recently about stakeholders, encouraging asset managers and banks to be more thoughtful about investing in, reducing carbon footprints and protection against climate change. And in particular, JP Morgan made a pledge very recently, as stated in the Wall Street Journal earlier this month, that pushing clients to align their activities with the Paris Agreement and commit to zero emissions by 2050. And, JP Morgan's move towards investing in technology for, clean tech. You mentioned that you're very involved internally in that effort. Can you talk a little bit about that effort internally and how it's translated into the projects you've worked on?
Yeah, and it connects to Troy's answer about returns. I mean, we're doing it because it's the right thing to do. We're doing it because our shareholders want it. But ultimately, we're doing it because it makes economic sense. The world is just generally moving in that direction. So what practically caused it is that there was a shareholder vote that got pretty close to the 50% hurdle last year that said that we do need to have a Paris aligned. And I think you're going to continue to see that shareholder votes drive other people to this action at oil and gas companies, at utilities. We've already seen it in Europe, and it's coming to the US. And it's not that we're pivoting away from oil and gas. I mean, if you look at most of the forecasts, even the IEA says that by 2040, 50% of our power is still going to come from oil and gas products. But that other 50% is a huge opportunity. So just give two examples of your questions, particularly when it comes to Houston. Within the last year, we took a Houston-based company called Sonova, a residential solar company, public. It's now a $2.5 billion market cap. And a week ago, we announced for BP an offshore wind deal in Massachusetts that was led out of their Houston office here. And we're not doing that because it's good for the world. We're doing that because the market is moving this direction. And ultimately, just the growth and the returns in the sector support itself. And you can look at, there are lots of analyses that compare higher returns in the oil and gas space, but they just have higher risk and lower growth relative to renewables. And that's an investment proposition that speaks for itself. So to be quite frank, it's not only just that the world is moving this direction, it really does make economic sense for both investors and banks.
Great, thanks, Zach. But we all know that investing in this space is very different in many ways from traditional investments. There are a lot of points along the technology development process where there's risk of failure, and you need many rounds of capital to get something from concept to commercialization. How have the traditional models around providing capital changed to adapt to this space? Christina, you want to speak to that?
Yeah, if I can jump in. I think the models are changing, and something that we're seeing is there's a lot more capital being attracted to low carbon technologies, but it also means that the funds being created are larger, right? So Amazon announced that they have a $2 billion climate pledge fund. Microsoft has a $1 billion effort. There's also the development with rolling funds now being put in place, and I think that's a reaction to understanding that this is a capital intensive process in terms of investing in the energy space and making sure that funds have the capital needed to be able to support those investments long term. And other changes that we're seeing that kind of tweak the model is looking at the focus on syndicates. We're looking at the law more transactions, at least on the early stage of technology development, of having strong syndicates of both financial and corporate co-investors. And the last part that we're doing quite a lot in BEV is the focus on policy. We have someone on our executive team that focuses on policy changes and how that should inform our decisions in terms of making these investments. So we see more multidisciplinary funds being set up that are larger, and some may have a longer time horizon. Specifically for BEV, we're working with a 20-year time horizon. But that doesn't mean that we are compromising on returns. As both Zach and Troy said, like we're doing this to build profitable companies and profitable businesses. And we see a lot of the macro trends that support it. We see macro trend of super chip and cheap intermittent electricity being available that allow us to invest in things like electrolysis in a pathway that will become cost competitive. And to bring it back to Houston, so it's a trend that I've been specifically extremely interested in, is looking at the oil and gas innovation and technology and the speed that shale has developed and the cheap cost for shale development, and how can you use those technologies in the low carbon world. So we invested in companies that are using drilling technology in a new way to develop geothermal assets. And we also invested in a company called Fervo, and then we also invested in a company that is using oil and gas stimulation technology to create energy storage mechanisms in the subsurface, geomechanical energy storage mechanisms. So we keep seeing these macro trends of how are we getting to cost competitive levels and how are we utilizing technologies from other industries in the low carbon economy.
Great, thanks, Christina. Troy, anything to add to that?
Look, I think Christina hit the nail on the head. I mean, this is a capital intensive industry. And you know that requires a real assessment of what those risks are to get a business commercialized. To go from a process technology that might work really well in a lab to building a first commercial scale plant is a daunting task that requires patient capital. It requires people that know how to pull all the constituent parts together, whether it's supply chain, the supply of feedstock or the offtake agreements, or finding the relationships with the engineering firms that can build the locations, finding a location that's got all the logistics that you need to make that work. Those are hard investments, and I think we're situated well to do those here in Houston, particularly with the innovative ways that we've thought about building facilities in the oil and gas industry.
We're circling back again on the advantages, Troy, you said, of being in the Houston area, the familiarity with raising large amounts of capital, building large capital intensive projects, as well as the human capital and knowledge to do that. What do you really see as Houston's strengths to excel in this area? And where are some of the areas where there still needs to be improvement? Where are the gaps in having more of this capital investment in the Houston area?
Is that addressed to me, Liz?
Sure.
Okay. Well, look, I think one of the gaps is being closed right now. The panel just before us, and it's so exciting to see all of the incubation, the incubators that are being established here, and seeing the leadership that Rice has exhibited by setting up the ION and all of the higher ed groups around town. So I think that was one of our biggest gaps in this city, but it's starting to be filled. I also think attracting more capital to firms here in Houston that can help make this energy transition, provide the low carbon future that we're all excited about, is another place that we can continue to make progress. Great.
Zach, I know pre-COVID, you like me are a commuter from the New York area to Houston. I know I'm usually down there a few times a month, and I know you are as well. Probably been on a lot of the same flights together. What is your perception of development of investment in this area in Houston, coming at it from a New York perspective?
Yeah, happy to. And look, Houston clearly has the perception of being an oil and gas company, an oil and gas focused city, but very easy to change that perception. We took a large company public today called Array Technologies. It creates solar trackers, a little chip that goes kind of under the solar panel, makes it track the sun. Started in Albuquerque, New Mexico, 4 or 5 years ago at this point, now $3 billion company. You need an ecosystem infrastructure, but you don't feel like the reputation of any city should hold you back. And I agree that having the initial funding sources is probably a little bit of a death trap in Houston, and it's great to see they're fixing it, but there is certainly a light at the end of the tunnel. And Michael referenced this a little bit with EGPR, but use the strategic network and the ecosystem you have. And if you look at the end game, every single oil and gas fund, Warburg, NCAP, they're all transitioning to renewables. You have oil and gas companies that are focused on it. You have the utility, Centerpoint, Encore, they're focused on it. Every European utility is headquartered there, EDPR, Enel, BP. These are all folks that want to migrate in this direction. And I think the recommendation I'd give is know a little bit your end game. And if there is such a momentum behind the strategics on this space, build a product that's trying to support them. We're seeing this, at least I've seen it a little bit in Boston, really focused on anything that's offshore wind, and Brooklyn very focused on a lot of microgrid technology, and Bakersfield really focused on renewable diesel and renewable natural gas. And there is so much need for, whether it's on the EV charging side, I know you guys love your cars, or on the hydrogen side with all the oil and gas, like build a product that I see is like that, where you see the demand coming, and there's going to be so many people that want to partner with you and want to see that success. And you can create that partnership, whether it's financial or just strategic, earlier on in your growth life cycle to kind of turbocharge that growth.
That's great. Michael, as someone who's been around this space for as long as you have in Houston, what have you kind of seen happen over those years in terms of making Houston a more hospitable home for this business and raising capital? And where do you still see where there's room for improvement?
Well, I go back and forth. Sometimes I'm just, wildly optimistic about Houston's prospects as a renewable energy leader. And then sometimes I get utterly depressed. And on the very positive side, you've heard the sort of entrepreneurial attitude. Troy talked about, like, we actually build things in Houston, and we have lots of engineers and project finance people. A number of the people on this panel don't live in Houston. And if we were killing it, y'all would all be moving to town. So we're doing something not quite right there. And somebody made the comment about, like, the oil and gas city, and it is a brand. We do have a bit of a brand issue, and so on the one hand, we are in ERCOT, and ERCOT is a tremendous advantage because you can build lots of renewables. That gives rise to the prospect of very interesting electrification opportunities driven by cheap, clean power. I think that's a great advantage that maybe we haven't talked about. But ERCOT is in Texas, okay? And TxDOT is about to build a 24-lane freeway through low-income neighborhoods, a project that would make Robert Moses blush. And it's 2020. And there's some local political opposition from our mayor who's trying to bend the project, and the commissioner's court, they're trying to move it. But, the Greater Houston Partnership, for example, Brett, to not praise our sponsor, but they're in full-throated support of a project that has, serious equity consequences and sort of hardwires us for high carbon emissions. So unforced errors like that make me worry about, the extent to which we get the magnitude of this challenge. We've got flooding challenges, we've got carbon challenges, and we're hardwiring the city for super high emissions. So now maybe we'll be driving EVs on this 24-lane freeway, and it will all be good. But we do some things that are like really smart, and Mayor Turner has rolled out a climate action plan that is really a fantastic roadmap. Will we follow that? We'll have to see. So there's a lot of ground for optimism. But there's also, we do commit a fair number of unforced errors, and the competition is not like, are we going to beat out Denver or Minneapolis or San Francisco as the energy capital of the world? There's like 100 cities around the planet that would kill to have to seize that title of energy capital. So we got a lot of work to do. We got to keep our eye on the ball, and we got to get all the different pieces to work together, not just the capital formation, but the whole sort of ecosystem, if you will, writ large.
Just on
that,
using your assets for good. When we cover renewable services companies, it's the same energy service investment bankers that do it because they understand how to do oil and gas services. They're the best equipped to understand renewable services. And I'll give a plug for one of Troy's companies. Maybe Troy, why don't you describe Priority Power, just using the oil and gas asset to benefit renewables? I think it's great.
Oh, thanks, Zach. Yeah, we're excited about Priority Power. It's a business that does exactly that. It's an energy services company that helps commercial and industrial businesses deeply electrify their systems, whether it's behind the meter solar and battery systems to run your manufacturing plant, or it's just a connection to the grid. They do it all. And frankly, I think Michael hit the nail on the head just a moment ago. I mean, the cheapest power in the world is in West Texas right now. And we're building out a massive data center with net power of like $0.015 a kilowatt over the next decade, and largely because with the deregulated environment that we have here, you can provide that excess power back into the grid when it's necessary, and so demand response is a critical component of that. And so yeah, thanks for letting me do this.
That like cheap power is also what's necessary to make hydrogen work, right? Christina brought it up. Like for the way to make the biggest impediment to the hydrogen economy is cheap power that can be used for electrolysis to create hydrogen. Companies like Plug Power and Ballard Power, the largest hydrogen companies in the world, which just talking about returns in the ESG sector, you know, these companies have gone from $500 million market caps to $7.5 billion in 6 months. And they're setting up all their infrastructure right where the cheapest power is in Texas. Like use ERCOT as an asset, as Michael said.
And Zach, just to add to that, like we've been looking at electrification of many industrial sectors. Like hydrogen is the one that's getting a tremendous amount of attention right now, but you could also look at electrified steel production. You can look at things like ammonia. You can look at the chemical sector. That's a huge asset that needs to be used, even for early technology development and demonstration, where you need to have that availability of super cheap power.
Christina, anything else in terms of your observations as someone formerly in Houston, but now outside of Houston? Any observations from where you sit now in terms of the strengths and weaknesses of Houston to further grow in this space?
Yeah, on the strengths, I really want to reinforce the labor and recruitment. Like, there's a lot of engineering expertise, there's a lot of innovation, there's a lot of young people that want to work in the low carbon space. So I've had a company relocate to Houston from San Francisco, right? Because of the engineering talent and because it's a lot of cheaper there for them to run their operations. And they also have access to all the energy majors that they need for some of their technology development. So I think that's a huge asset. The other point I want to make is that there is still the brand and perception. Like when people think of Houston, or when I was talking about being in Houston, they think about oil and gas. They don't think about renewables. And that it is changing, and the incubators and the accelerators and the very strong angel network as well is helping change that. But I think it is a matter of getting all the stakeholders to start saying the same message and also acting on it. And when I'm saying all the stakeholders, I mean the city of Houston, the corporates, the trade associations that have been working with their oil and gas companies can also be talking about energy transition. The universities, the more vocal and branding and image that's being shown externally to show that Houston is serious about low carbon technologies and clean energy and wants to support it from all the facets of the ecosystem, the more they can help attract people.
No, that's great. So, you know, part of the conversation is there a challenge in attracting clean tech startups to the area because there is a lack of capital to invest in them? And how do you bring the capital to invest in them? And do you need those clean tech startups to be there to attract the capital, kind of a chicken and egg scenario? It sounds to me from all of your conversations and you know, the capital that you bring to bear for these projects, that there isn't a lack of capital or a lack of opportunities to fund. Do you think that's right? Or do you still think that there needs to be a stronger message to draw clean tech startups to Houston?
Well, I mean, clearly you can't do enough. You have to do everything that you can possibly do. And as was pointed out, yeah, Houston is like particularly good at deployment. We're probably not as good as some areas about sort of the basic, you know, R&D driven companies. And that's, you know, that's going to require, and it's happening, that, you know, more attention from the universities, U of H, Rice, et cetera. So I think there's more to come there, but on the deployment front, I think we're in like reasonably good shape. But so if I could just draw a distinction between, you know, sort of the people in a lab versus people deploying projects, we're a little bit better in the latter area than in the former. But, you know, Greentown Labs, we're going to fix that at Greentown Labs, by the way. But and Greentown Labs plug, in case you weren't on the last panel. If you do have such an idea, please come to Greentown and we will hook you up.
Zachary, yeah, Christina.
Capital should hold you back. Like, capital today is fairly global. It moves across the US easily. Like, ESG capital is even more global, and good products sell. Like, there is no, I can tell you, if you've got a good ESG product, you've got every source of capital on the phone right here. We're always happy to talk to you. And I just find that there's no type of investor that's going to turn down a good product in the ESG space. The total addressable markets are bigger than there's nothing bigger than the energy sector. So I wouldn't let capital create a chicken and the egg and kind of scare you away that there are no VCs or funds in Houston. Create the best product. If your end customers are in Houston, that's a good place to be, and the capital will follow you.
Christina?
I would just say that one of the gaps that maybe has to do with taking technical risk is, okay, you can find a VC for the early stage technology development steps. It might be in Houston, or as Zach said, at capital flows. You can find the deployment capital. There's a lot of private equity groups setting up their energy fund, their renewable energy funds. Who's going to do the first of a kind plant? So where you do still need to, they're going to try. That's the part that, at least from our side, we need to merge the gaps and be able to bring a lot of the technology that we're seeing and bring that first of a kind plant in Houston, because there is the engineering expertise to do it safely in a large scale. And we want to see more of that.
And Troy, you've talked about the capacity of Houston to do that physical development, both in terms of, you know, prior experience, the human capital to do that, the relatively low cost environment to do that. But it sounds like what I'm hearing is among the group is that maybe what's missing is, while we have that capital development expertise in Houston, maybe that early stage technical development isn't yet in Houston, and maybe that's being drawn to or remaining in other cities like San Francisco, Southern California, Chicago. What are your thoughts on that? What do you think needs to be done to draw some of that early development R&D expertise to Houston? Since everybody seems very confident that Houston has that later stage actually build it capability, but it seems like we need to merge the two.
Yeah, look, I think there's pockets of expertise in all sorts of different places. So we certainly have some of it here. We need to develop more of it through the universities, through the Greentown Labs, through the incubators and the accelerators. But it doesn't matter where you develop it. Bring it here to Houston, and we'll help you commercialize it. You know, getting that business through from the development of the pilot to the first of kind facility, we think is one of the most lucrative, frankly, and most misunderstood areas of investing in low carbon the low carbon economy, and that's what our funds are focused on.
And Troy, in that regard, for those early stage companies, and Christina, I know this is your space as well. For those early stage companies, what is most important for them to demonstrate in terms of attracting capital, right? Because usually a barrier is there's great technology and ability out there, and there's capital on the other end of the spectrum. What do you really need to bring them together in Houston?
Yeah, I mean, first and foremost, we have to be able to all be comfortable that the technology risk is behind us, that you've piloted something, you've been able to demonstrate that the technology risk is behind. And sometimes that takes a long time to really sort through. And is the product that you're making, is it a drop-in replacement for an existing chemical or material? Is it going to require the customer who's going to take that material to modify their processes in order to use your product? So there's a bunch of risks that we have to triangulate around, because ultimately to commercialize something, you have to have someone who's willing to buy the product, and that's a big step. And I can't tell you the number of process technologies that we've looked at that we can't get comfortable that there's a market for the product. That has changed a lot in the last decade, because more and more corporates are willing to take a little bit more risk on that front, because they see the greenhouse gas reduction capability and potential. And so that is the accelerant that we think is required to really make these businesses work. It's getting past that technical risk, making sure that the product that's being made has a real commercial viability.
Christina, I think you might have something to add. I know you're the one who's probably involved most early in the process in terms of technology risk. What are your thoughts on that?
Yeah, for us, it's looking at the unique technology that's differentiated and also defensible from an IP perspective. We also look at there is a big market at the end and the customer wants to buy it. So we spend a lot of time on the techno-economic model of what needs to go right for the cost to get to a certain level, to the point where Troy would be interested, and take out the biggest component of technical risk that we can while the technology is still at the pilot or the demo scale. But there's always some remaining risk that has to do with the scale up from your demo facility or your pilot facility, where the most of the scientific risk has been retired, to the engineering risk, right? So how do you jump from your demo plant to your first commercial plant, where there's still some engineering risks, some heat integration, some scale up that definitely needs to take place. That's the part where we try and reserve enough capital to be able to support our companies through that step, so that they are at the step where they have the first plan, and Troy will say, okay, I've seen it working once, let me build 10 of these. That's how we approach it. And then the techno-economic analysis and what are the risk retirement steps every time of us putting capital in is what we're focusing on risk.
And Christina, go ahead, Zach.
I know I'm the one not supposed to be asking questions. I'm just curious on this conversation of Houston versus other cities. Christina or Troy, have you guys ever asked a company to change locations and say, your end product is better in Houston, so you should move your company to Houston or a different city?
We're very fortunate. We just had one of our newest investments, a business called Utility Global, which is manufacturing fuel cells with 3D printers, moved to Houston, and they were excited to move to Houston because of the labor force and because of the cost of setting up real manufacturing here in Houston versus where they were previously.
So we've had one that made the decision on their own, and it was driven by labor force, and it was definitely the right decision for the company, so that almost all the employees are based in Houston. And we have other companies that are extremely early on, that are still a seed stage. They have a small pilot and they're thinking of where they're going to expand the presence. So there is one very concrete example in the wind space that we've actually suggested to them that Houston might be a good place for them.
Yeah, I'm just thinking through the alums of some of the early companies and where they've set up. And it's about half, so these are people that worked with Superior or Babcock and Brown in Houston or Horizon back in the day, and then they went on to set up their own companies. About half of those stayed in Houston and about half left. So it would be an interesting research project to say, okay, like, why didn't y'all hang out here? That'd be an interesting data point for somebody to, maybe our host could research that. I do want to make another point about capital, and I know we're talking about money capital, but human capital is a big part of this equation. And Houston is one, I think it's the second most important gateway city for new immigrants. And people come here from over the world and they feel quite at home because the chances are very, very high that there's already somebody else from their home country. And if you look at, I'm just looking at like the attendees list here, and many of us in Houston who've been involved in renewables over the years, many of us are immigrants, and immigrants are more likely to start new businesses, and because maybe we have to or something, I don't know. But the fact that Houston is such an important gateway city is a big deal in terms of technical talent, because it's the low cost of living, the sort of welcoming environment. Those are pretty big advantages that, I think Denver and Minneapolis and a few other cities probably would have a hard time replicating. That the sort of the welcoming attitude, cost of living, and just sort of ease to sort of make your way in the city.
Well,
Hey, Christine, Liz, I'm gonna jump in here because we have a bunch of questions and we have about 10 minutes left. So
okay.
There seems to be a real appetite for maybe from folks who are listening to ask some questions. So let me just field a few that I'm seeing, if that's okay. Sure. There seems to be a real question around policy, and in California there's a policy driver, in Europe there's a policy driver, in Texas we don't have that policy driver. How do you guys see the role of policy playing into what we need to do as a state?
Well, I'll jump in first. I mean, first and foremost, product has to be economic and standalone. Policy is important and certainly can help make those transitions easier, so long as policy is durable. We're happy to invest behind like the Renewable Energy Directive 2 in Europe because we believe that's a very durable policy framework that the EU has adopted. The U.S. is a little bit harder in my view. I mean, depending upon the LCFS standards in California, can work for you for a moment in time, but may not be there in the same volume as you think about a longer duration investment. So, our view is it needs to be something that's economic in the here and now, and not dependent upon policy.
Texas is one of the lowest portfolio standards, and it's got the most amount of wind and solar out of any other state. I agree. Like getting policy helps, and clearly EV charging is going to be bigger in California in the near term than it is in Texas, just because of the support that it has from LCFS and other credits. But over time, in terms of scaling something and choosing an end location, people should choose based on economics and not based on policy.
Yeah, so let me just differ a little bit with the panelists here. Zach, you point out that we've blown through our RPS, but Texas got started in renewables with an RPS. And Brett, you were there at the commission when that happened. So, and it wasn't easy. It was part of a whole discussion. So particularly for getting new markets going, policy has been tremendously important in Texas and elsewhere. The CREZ transmission, we talk about like the low power rates in Texas. One of the reasons for that is that we had an affirmative policy in the mid-2000s to do a very extensive build out of the electric transmission grid. That the coalition that brought that about would be difficult to replicate today, but it would be a fantastic thing. If you think about, like, I want Texas to lead the charge in hydrogen in the 21st century. You build out the grid and that will happen because we've got the other resources, but you have to lean in on the policy around building out the grid. So I think we've got a lot of things right in terms of the market and so on, but we need to continue to look for ways where we can lean in as a city and as a state to make that happen.
Yeah, and when
Go ahead.
when you're an early stage company and you're thinking, okay, where am I gonna build the first demonstration or the first commercial, it's still expensive, but I need all the advantages I can get. That where policy is more favorable for you will sway the location both of the company and the asset. Right, so the LCFS standard, I agree, it might not get you to the market scale you want in terms of building the largest company, but it will help you build the first demonstration. It will help you get your costs down for those initial units. So it could sway decisions of companies of where they're going to go.
Yeah. In fact, we're sort of hearing that with hydrogen, that we're the low cost producer in hydrogen, but very difficult to get heavy duty trucking for hydrogen started here because we don't have an LCFS or any sort of incentive. It's all the focus is on California. And just, to Michael's point, is it impractical or inconceivable that we might build a coalition to work on hydrogen or CCUS or something like that, to have, the same coalition, a similar coalition to what we put together for CREZ? That's rhetorical. I guess I would hope we could, because it would be pretty amazing. If
well, I mean, we certainly have a lot of the pieces. We've got well-functioning markets. We've got fantastic resources. We've got lots of pipelines. So the answer ought to be yes, and we may not have to lean in that hard to make it happen.
Yeah. Well, we're almost at, we have about 4 or 5 minutes left. I started this conversation with a quote from Bill Gates, and Christina, you probably know it, about energy miracles. That was in his 2016 letter that he writes. And what he talks about there is, that we need these huge leaps in technology. And I guess one question is that still true? Are we doing that? And I guess the second question, which one of the we got on the chat function, are we moving fast enough? And if not, what do we need to do to move faster? So this is kind of, I think, the theme of the conference. What do we need to do? Because this is not just about building profitable companies. It's really about solving this global crisis that we're in. And so, do we have the energy miracles we need, and are we moving fast enough? Who wants to take that one?
Just to start on the energy miracles, we absolutely need more technology innovation. I mean, climate change is a massive problem. It's multifaceted. And we think there is still a lot of it will be addressed by existing technology scaling up, but we still think there is a gap in terms of funding the right technologies and helping them scale up and go commercial. And in terms of moving fast enough, just speaking for myself, I wish we were moving faster. But I'll let someone else comment on that one.
I'm with you. You could always be moving faster. I was reading this morning that like 50% of the US's, like we've shown that we're cutting down emissions, is just moving all of our steel and ammonia production and all these processes, industrial processes that produce a ton of carbon. We're just moving it to other countries. We're not actually solving the issue. We're just outsourcing the issue. And so it's not, there has been a tremendous amount of progress just across the entire energy value chain. But I think we're still in very early innings of trying to conquer this.
Yeah, and I'll just sort of restate something I said earlier. The economics have to drive. in order to get things to really scale and scale quickly, they have to be economic. So long as they're not economic, things won't scale. And so I know we're all moving as fast as we all can. And we're seeing as Zach pointed out, the SPAC market is hungry for these types of investments. I hope it doesn't overheat, because it could be another setback like the clean tech movement had back in 05 and 06 and that time period. We're excited that things are starting to demonstrate real economic viability, and we think that they're going to start to take substantial market share really across the industrial economy in the coming years. So I think we are moving fast, and I think it's going to start picking up more and more steam.
Okay, we have time for one last question. And, we've had this theme around economic justice, and I think it's come up in a couple different times in this panel. How do we make this into a transition, and how do we make this sort of underserved communities? How ought we be thinking about that? Or is that something we ought to be thinking about? Or is this just the market's going to take care of it? So I'd be curious on people's thoughts on that.
So this is not an area in which the renewable energy sector excels. Okay, broadly speaking, it's the most of the folks are Anglo, and we have, and certainly don't reflect the population of Houston. But so we should do everything we can in terms of outreach to minority communities so that they're full participants. We're probably, I don't know how many cities in the country have a high school for energy. We have one of those. We should lean in really hard to get places like that every possible resource that they could ever ask for. And in terms of the blue collar workforce, I think we're probably doing better than most. But this is another area where, it's hard to do too much.
Okay. Other thoughts on that question as we wind it up?
I think it's unfortunate because we're trying to get costs down, and for a lot of these technologies, the costs are only competitive on the coast or in Houston, or only in the most successful areas. You look at EVs, you look at rooftop solar, and there is just focused on wealth. There's a clear bifurcation.
Well, I'll tell you what, why don't we leave it there? We're right at time. It's been an hour. This is Liz. Thank you so much for putting this together. It was really an interesting discussion. I learned a lot, really, and I frankly have left encouraged by this discussion. And Christina, when are we getting you to move back here? That's our question that we want to know. So we're looking forward to
COVID, but yes, I still, well, pre-COVID, I was there every quarter. So yes,
okay.
I do need to make it more frequent.
Okay, well, we hope that we get that vaccine that Bill has been working on, and that you can start traveling again. And we hope to see you in Houston quite frequently, and that's true for Zach as well. So thank you to the panel for a really interesting discussion. We're going to take a 15-minute break. We have two panels left, a really interesting panel that's a little bit out of the box. We'll be talking to some of the foundations and what I'm calling facilitators, which we haven't heard from yet. So the Oil and Gas Climate Initiative and the Gas Technology Institute, and the role that they play in pulling this whole ecosystem together. So stay tuned for that. And then obviously we're going to have the wind up with Franklin Chang Diaz at the end. I think you'll want to stay around for that. It's going to be, I think, an amazing discussion. So why don't we take a 15-minute break? We'll be back at 1:15 with the last panel, and then roll right into our keynote. Thank you guys, and look forward to continuing to work together. Thanks for all the help.